If you think the UK's economic problems are bad, what's coming next might redefine the word crisis, because the numbers no longer match the official narrative. The UK is facing something more complex than inflation, more disruptive than Brexit, and more enduring than a simple recession cycle. Today, we're breaking down why economists, investors, and entire industries are warning that the British economy may be entering its most dangerous decade since World War II. By the end of this video, you'll understand the hidden pressures behind weak growth, the structural flaws slowing the economy, and the single most underreported factor that could decide the UK's economic future. Let's dig in. To understand why the UK economy is flashing red warning signs, imagine an engine running on lower and lower fuel, but still being asked to accelerate. That's the British economy today, technically moving forward, but each year with less power. GDP growth, a fraction of what major economies are achieving. Productivity, stagnant for over a decade. Investment, lower than most comparable advanced countries. This isn't a sudden collapse. It's a slow-motion structural weakening, and the average person only feels the symptoms. Rising food bills, squeezed wages, higher taxes, impossible mortgages, and a sense that living standards are quietly eroding. But to understand how the UK got here, we need to break down the forces pushing the economy toward the danger zone. When global inflation surged after the pandemic and Russia's war sent energy prices soaring, the UK was hit harder than most of Europe. Why? Because the UK relies more heavily on imported energy, especially gas. Because the UK's workforce is smaller and recovering slower. Because supply chains already weakened after Brexit took another hit. This created a perfect inflationary storm. While the Bank of England aggressively raised interest rates to fight it, borrowers, especially mortgage holders, were hit like a hammer. Unlike many countries where people lock in 20 or 30-year fixed mortgages, UK mortgages typically fix for only 2 to 5 years. That means millions of households are still rolling into higher rates. And when a household pays hundreds more a month for a mortgage, that's money not going into the real economy. Restaurants, services, small businesses, travel, consumer goods. It's a quiet tightening, happening slowly, household by household. If there is one word that defines the UK's long-term economic struggle, it is productivity. It hasn't significantly grown since the 2008 financial crisis. This is not normal for a developed economy. While countries like the US, Germany, and even France have seen increases, some modest, some strong, the UK has remained stuck. Why is this so dangerous? Because productivity is the fuel of a modern economy. It determines wages, it determines growth, it determines competitiveness, it determines how much improvement in living standards a country can expect year after year. Low productivity, weak wage growth, weak wage growth, weak consumer spending, slow GDP, less investment, even lower productivity. This is a self-reinforcing cycle, and the UK has been trapped in it for more than a decade. Economists often describe the UK as a country running on yesterday's money. Business investment, spending on factories, technology, equipment, innovation is far below that of similar economies. Why? Uncertainty after Brexit, high energy costs, a volatile tax environment, tight labour markets, rising borrowing costs, weak long-term economic confidence. When businesses invest less, economies innovate less. When economies innovate less, productivity stalls. When productivity stalls, wages freeze. This is why the UK's wage growth consistently lags inflation. Even when people earn more pounds, those pounds buy less. It's not just a cost of living crisis, it's an opportunity crisis. One of the most alarming developments is the UK's shrinking labour force. Hundreds of thousands of people left the job market after the pandemic, with a major rise in long-term sickness much higher than peer countries. Add to that an ageing population and stricter immigration policies, and you get fewer workers, lower economic output, higher pressure on public services, increasing government spending, lower tax revenue. This combination is toxic. A smaller workforce means a heavier load on fewer people. That means higher taxes, lower disposable income, and a weaker engine powering the entire economy. Here's a fact that shocks many viewers. The UK is experiencing the highest tax burden since the 1940s. And yet, public services, NHS, transport, social care, education are under extreme pressure. Waiting times are long. Infrastructure investment lags. Local councils are running out of money. People feel squeezed from both sides. Higher taxes, weaker public services. This is a dangerous political and economic combination because it erodes trust and makes the business and consumer environment more fragile. Every modern nation carries debt, but what matters is how fast that debt is growing, how expensive it is to service. Here's where the UK faces serious trouble. With interest rates at multi-decade highs, the government now spends more servicing debt than funding major departments like education or defence. This means future governments, no matter the party, will face tax increases, spending cuts, or both. The room for manoeuvre is shrinking, and the cost of previous political and economic decisions is catching up. In the 2000s, the UK was one of the fastest growing advanced economies. Today, it has fallen behind Germany, behind France, behind the US, behind Canada, behind Australia, behind major EU averages. This matters because global companies choose where to invest based on stability, talent, infrastructure, growth potential, market access. And the UK, once seen as a top-tier investment destination, lower than ever, now ranks. Some manufacturing projects have moved elsewhere. Financial services firms shifted operations to the EU. Tech companies see the UK as uncertain compared to competitors. This slow erosion is invisible to the public until it accumulates, and then it becomes undeniable. Even if all the macroeconomic factors were fine, consumer sentiment can still drag an economy down. And UK consumer confidence has been consistently weak, often at or near record lows, heavily affected by inflation, interest rates, and stagnation. When people feel uncertain, they spend less. When they spend less, businesses earn less. When businesses earn less, they hire less. And when hiring cools, the economy slows further. This is how recessions quietly form. So here is the real challenge. The UK isn't suffering from one big economic problem. It's suffering from several interconnected ones. Inflation, higher rates, collapsing affordability, weak productivity, stagnant wages, weak demand, high taxes, lower spending, slower growth, a shrinking workforce, higher government spending, rising debt, low investment, poor innovation, fewer opportunities. These aren't temporary shocks. They are structural failures built up over a decade and now converging at the same time. This creates a risky scenario where even a small external shock, a global recession, a geopolitical crisis, a financial instability, could push the UK into severe territory. And this brings us to the most critical moment in the entire story. The UK is approaching a crossroads that will define the next 10 to 20 years, not based on one government decision, but on the entire economic model. Here's the most important truth the public rarely hears. The UK cannot return to strong growth unless it solves its long-term structural problems, and the window to fix them is shrinking. The combination of low investment, weak productivity, high debt, an aging population, stagnant wages, expensive energy, high taxes, slow innovation, creates a scenario where the country risks being trapped in low growth for an entire generation. This is the moment where the UK decides whether it rises with the new global economy or slowly falls behind. The British economy isn't collapsing, but it is weakening, slowly, steadily, and structurally. Inflation made the wound visible, but the deeper problem is long-term economic performance. The UK can absolutely recover, but only if it addresses the core issues: boost productivity, attract investment, lower barriers for business, repair public services, rebuild the workforce, modernise infrastructure, create a stable, predictable economic environment. Without these changes, the UK risks falling into decades of stagnation. With them, it could re-emerge as one of the strongest and most innovative economies in Europe. The next decade decides everything. And if you enjoyed the video, make sure to like and subscribe, and check out the channel to find more amazing and new videos.